Hi, welcome to the second mini lecture for Chapter 2, and we're going to be focusing this entire mini lecture on this one page of the chapter, and this is Learning Outcome 1-2. It will be focused on the most important concept of the semester, which is the accounting equation. This is one of those things you absolutely need to remember and fully understand because it forms the basis for recording all business transactions. And it is also the basis for one of the most important financial reports, the balance sheet. So it's also called the balance sheet equation. Okay, so let's take a look at it. Assets equal liabilities plus stockholders' equity. And it's called stockholders' equity because we're talking about corporations. If it was a sole proprietorship, we would call it simply owner's equity. And this is a math thing. The total dollar value of the assets must equal the total dollar value of the liabilities plus the total dollar value of the stockholders' equity. So let's go through each one of these items individually. But before we do, I want to call your attention to this separate entity assumption. And this is one of the cornerstone assumptions of accounting. The business itself, not the stockholders who own the business, is viewed as owning the assets and owing the liabilities. In other words, in the financial records and in the financial reports, we should only see transactions of the business and not the owner's personal transactions. The business and the owners are two separate entities. Okay, so let's start with the first element of the accounting equation, and that's assets. Now, this is a pretty big definition, and it's a little confusing. It says assets are economic resources presently controlled by the company. They have measurable value and are expected to benefit the company by producing cash inflows or reducing cash outflows in the future. Let's make it a little bit more simple. What you want to focus on is that they are economic resources. They're valuable to the company because they are expected to produce a benefit for the company in the future by helping it to generate a profit. So focus on the words economic resources, and you could use the word owned instead of presently controlled by the company that provide a future benefit. In other words, if you want, you can even write that shorter definition down next to the end of that sentence. Assets are economic resources owned by the company that provide a future benefit. Okay, now let's move on to liabilities. Liabilities are measurable amounts that the company owes to its creditors. Sometimes these are called payables. And we use the word payables because the money is owed. Basically, if I had to choose a definition, it would be the word debts. Liabilities are the debts of the company. Stockholders' equity represents the owner's claims on the assets of the business. And the owner's claims result from two things. Amounts that the owners have contributed to the company, we call that paid-in capital. They contribute money or other assets in exchange for stock. Then there's earned capital, and that's the money that the company has earned through profitable operations. In other words, profit. We call that retained earnings. The word retained means kept, and your earnings are your profit or your net income. So let's take a look at a document that you'll find really helpful throughout the semester. So you should, in addition to the notes, you should print out this document. And this will come in handy all semester, as I mentioned. And there is basically the accounting equation. If for a moment we skip over looking at the right side of it, these are the items that we're going to learn in a moment are on the balance sheet. There's the assets, there's the liabilities, and there's the stockholders' equity. You can put an equal sign in between assets and liabilities, and then a plus sign between liabilities and stockholders' equity. Here's the definition: economic resources of measurable value expected to produce a benefit in the future. Now, right now, ignore that debits and credits stuff because we won't be getting into that until Chapter 2. But here are the various types of assets that a company could own. Cash, well, that's pretty obvious. We all know what cash is. Investments that are short-term investments. These are things that you could immediately sell and get cash for. Accounts receivable. Now, you might want to make a note on your document that explains that these are sales on credit. When you sell goods or services and customers don't pay, you would record that information in this account called accounts receivable. That's where we keep track of money that people owe us. And you have a right to receive that, so that's an economic resource. Short-term notes receivable. Notes are promissory notes. In other words, written promises to pay you. Someone's going to be paying you in the future. Notice we use the word receivable again. That's because in the future you're going to be receiving this money. And that's why it's an economic resource. If you're going to be receiving interest because it's due to you, it's interest receivable. Supplies are also an asset because we're going to use those to help us run our business and make money. Inventory are items that you're going to mark up and then sell to your customers to make a profit. Prepaid insurance is insurance that you pay for now, and it covers a while into the future. You might pay annually for insurance or 3 to 6 months ahead. If it's not used up, if it provides a future benefit, it's called prepaid insurance. Same thing with rent. If you have to pay for rent 3 or 6 months in advance before you use it, it's considered an economic resource because it's going to provide you a benefit in the future. Now, you might have investments that you hold for the long term, in other words, longer than a year, so they're called long-term assets. And these are other items that you might own. Now, they're in a special category called long-lived tangible assets because they last longer than a year, they have a tangible or physical existence, and you're going to use them to help you run the business. For example, land that you might own. We'll come back to land improvements. You might own a building. You might own equipment like, could be computers, or it could be machinery that manufactures things. There's a category for machinery here, and automobiles or vans or trucks. These are all economic resources that you're going to use that will help produce a benefit in the future, usually helping you make profit for the company. I'm sorry, I just realized you couldn't see land, building, equipment, machinery, and automobile. Now let's look at examples of liabilities or debts. We said liabilities are amounts that the business owes to creditors, and basically they're the debts of the company. You're going to notice that a lot of these items have the word payable in them, and that means you're going to have to pay the money in the future. When money is owed to you, it's an asset, and they have the word receivable because you're going to receive the money in the future. When you owe the money, you're going to have to pay it in the future, so they're called payables. Accounts payable is for purchases on credit. So if you want to add that to your chart, you can do that. Short-term notes payable would be for short-term borrowings using promissory notes. Written promises to pay money in the future plus interest. Interest payable is when you are going to have to pay interest and you owe it currently. Sales taxes payable is when you owe sales tax to the government and you have to pay it. And there's a variety of types of payable. So basically we just take the type of payable it is, for example, interest, and then put the word payable on it. Any amount of money that you owe is called a payable. There are also long-term payables or liabilities too. You can have long-term notes. You could even have mortgages. They'd be considered a long-term liability. Now, we could look at the stockholders' equity section here, but right now this is a bit confusing because there's some things here that we won't be learning about until farther on in the semester, like Chapter 11. So instead of looking at that, let's go back to our notes, and then we'll explain the rest of these items as well. But this is a great document to keep handy. Okay, so let's take a look again at the stockholders section here. We said that stockholders' equity has two parts: the amounts that were contributed by the stockholders, that's called paid in or contributed capital, and usually your stockholders give you money in exchange for common stock. The other part of stockholders' equity is the amounts that the company has earned through profitable operations, and we call those our earnings, our profit, or our net income. Okay, now how do we figure out how much the company is making in earnings or profit? Well, that's going to be the difference between revenues and expenses. So accounting systems separately track the revenues and the expenses. Revenues are amounts earned by selling goods or services to your customers. This is the main reason you're in business. So if you're a barber, you're cutting hair. If you're a landscaper, you're going to be mowing lawns. If you're an accountant, you're going to be preparing financial reports. It's whatever you do to earn money. That's your revenue. When a company sells products, it's often called sales revenue. And when they provide services, like mowing lawns, it's called service revenue. Expenses are the costs of doing business that are necessary to help you earn the revenues. And what we do is we take the type of expense you're paying for example, advertising, and then we just put the word expense next to it, call it advertising expense. You're going to have to pay for utilities, perhaps light and heat and water. We'll call that utilities expense. If you rent the building and space you're using, you're going to call that rent expense. If you have to pay for salaries or wages, you're going to call it salaries or wages expense. Expenses are used up benefits. Remember, assets provide a future benefit. Expenses means you receive the benefit. You used it up. You used up the utilities, the light and the heat. You used up the labor of your employees, so it's called wages expense. You used up insurance, so it's called insurance expense. So assets provide future benefits. Expenses, you've already received the benefit. You've used it up. Now, the way we figure out our net income is we take our revenues and we subtract our expenses. If the revenues are greater than the expenses, we have a net income. We've generated a profit. We've made earnings. If our expenses are greater than our revenues, then we have a net loss. So the way we figure out our earnings, the way we compute our earnings, or earned capital, is we take our revenues, amounts that we earn from delivering goods and services to our customers, we subtract out the costs of doing business for that same period, and that gives us our net income. Now, if the company decides they want to share some of that net income or profit with their owners, and in a corporation the owners are called the stockholders, we would call that a dividend. It's profits distributed to stockholders. In that case, we would not have retained the earnings. We would have given them away. So net income adds to our earnings, our retained earnings, and dividends subtract from our retained earnings because we've given that dividend away, or we've given the earnings away. Now, we just covered a great deal of information there. You may want to watch this again to make sure you fully understand these concepts, because they are the foundation of all that you will do this semester. Also, you should print out the document that we looked at earlier called Accounts in Each Category. I 3-hole punched this, so it's got some holes there. But what I usually suggest students do is I suggest that they make flashcards. See, assets is a category, and these are all types of assets. Cash is a type of asset, accounts receivable is a type of asset, and so on. So you might want to make a flashcard for the ones that we're going to see in the first few chapters, the ones I've highlighted in yellow here. And for example, you would put the word cash on the front of the flashcard, and then you would put the category, asset, on the back. And then for the liabilities that I've listed here in yellow, you would put the specific type of liability, accounts payable for example, on the front, and the type of account accounts payable is, liabilities in the back. So you would set up one of these flashcards for each of the liabilities in yellow here, and then put the word liability on the back. For owners or stockholders' equity, I would make one for common stock and put stockholders' equity on the back, and then make one for retained earnings and put stockholders' equity on the back. Now to figure out the net income, we take our revenues and subtract our expenses. The nice thing about revenues and expenses is they have the type of account right in the name. Service revenue, sales revenue, interest revenue. So they're a little easier to identify. But you can still do the same thing. Make a flashcard that says service revenue on the front and then revenues on the back. Do the same thing for the various type of expenses. And again, these are nice and easy because they've got the name or the word expense in each of the account names. So for example, rent expense goes on the front and the word expenses goes on the back as the account type. Now, I've been using the word accounts a lot when I've been on this page. That's because all of these particular types of assets, liabilities, and equity items are called accounts. Accounts are simply places that we record activity in these types of items. So in the cash account, we will record increases and decreases to cash. In supplies, we'll record increases and decreases to supplies. In sales tax payable, we'll record increases and decreases to sales tax payable. There's simply a place to record information about each of these different types of items. So I strongly suggest that you make flashcards for these to be able to test your knowledge, to test your understanding. You should also make one for the accounting equation and for all the various items that you see on the Accounting Essentials handout that I've given you. This is another document that you can find in the Chapter 1 folder in Blackboard. It's got some vocabulary that you really need to know. It's got the accounting equation here and the various things we've covered today, assets, liabilities, and stockholders' equity. And then in our next mini lecture, we're going to be talking about our financial statements or reports. And so you might want to make a flashcard with the name of the financial statement and then the calculation or the formula. And I suggest that you should quiz yourself daily to make sure that you know this material. Because in Chapter 2, we're going to assume that you're going to, or that you know the various types of assets, liabilities, and owner's equity, that you know the accounting equation, that you fully understand this information. And the reason why it's so important is that the way we record increases and decreases to assets, for example, is the opposite way that you record increases and decreases to liabilities and stockholders' equity items. So if you don't know the account type, you won't be able to apply the rules. It's very important that you know which is which. If you don't get a firm grip on the information right from the beginning of the semester, It's very difficult and almost impossible to do so after the first test, after chapters 3 or 4. By that point, you will have missed so much that you won't be able to catch up, and I want all of you to get A's in the course. So please learn all the information on the Accounting Essentials document for chapter 1. Make flashcards and quiz yourself. And please make flashcards for the accounts in each category and quiz yourself daily to make sure you understand that information as well and can remember it. If you do, the rest of the semester will be so much easier and you will be successful. So please make the flashcards and quiz yourself a bit, or if you feel you need to, watch this mini lecture again before doing so, then make the flashcards when you feel confident and quiz yourself, and then you can move on to mini lecture 3, which is learning how to prepare the financial reports, which we call financial statements. Thanks for your attention.